Ever been in a situation where you see something that is showing up on a pattern, on a bearish pattern, and you're not quite sure how to handle it? In this particular session, I want to talk about puts, and I want to talk about put spreads. I want to do a comparison of the two for you. So let's go ahead and get started. The basics, all right? Buying put options. Let's talk about put options first. Well, they are bearish. They are a bearish directional strategy. It is literally as simple as buying a call option. All right. They are for rewards. They happen to the downside. Risks are if the market goes up, because if you're buying puts, you're expecting the stock to fall. So your risk is going to be if the stock stays sideways or the stock goes up. What we're doing is we are buying to open a put, and that gives us the right to sell a specified security or ETF at a specified date at a specified price. Okay. That's all a put option is. It gives you the right to sell. And so think about this. If a stock is gone down, you can do a couple of things with it. Shorting it. You could short the stock. A lot of people can't short stocks because shorting stocks come with a high margin requirement. All right. And that short there, you got to have some capital if you're going to short a stock, because the risks against you are much higher than someone who buys a stock that has risks to the downside. So a short put risk graph, a conventional risk graph, is going to look like this. You know, this is your stock right here. It can go up, it can go down. If the stock goes down, puts go up in value. If the stock stays sideways or goes higher, puts will pretty much, you know, you risk what you put into the actual trade. Okay. So we have unlimited potential. We have limited risk with a put option. Here are the risks that I think that are out there. You have delta risk. That's where you have no stock price movement. If you buy a put that's at or out of the money and the price of the stock doesn't go anywhere, that's a risk to the put buyer. You have theta risk. That's where the price could go down, but the option could collapse faster than the stock going in your favor. That's called theta risk. And then finally, you have vega risk, and that's where, you know, a lot of us buy expensive options. These are where you buy options that are overpriced. Now, I'm going to give you an example of one that just right off the bat. A couple weeks ago, when oil spiked up and jumped up to 130 or 128 overnight, coming into that morning, there were people that were buying call options, but there were also some people buying puts. The problem with both of those groups, they overpaid for those options. So as you can see, oil has come back a little bit, but it's come back up, and it's actually exceeded those prices. But do you know that there are some call and put traders that lost money even when it went in their direction because they just overpaid for those options? Now, how do puts get profitable? A couple ways. Stock price goes down and the puts rise in value where the stock drops faster than what you paid for the put. And of course, you're going to see a rise before expiration. Now, option prices could get more expensive, meaning that the stock in question doesn't have to move, where you might see puts and calls get more expensive. It might be something like an upcoming earnings report, all right? So the puts would gain value even if the stock doesn't move. That's called an implied volatility spike. That's good for you. That's good for the put buyer, so long as you exit the trade before that volatility could turn around and revert. So let's construct a put option with TripAdvisor. So, you know, TripAdvisor is coming up. It's not a fan favorite. It's actually seasonally bearish right now. And I thought what we do is take this as a case study, because I think this makes a great case study in so much that when you compare short stock to puts, you'll see that that the puts really win out, and I'll show you why. So in order to construct a put with the Hub platform, what I'm doing is I'm bringing up the chart in question. This is TripAdvisor, and you can see TripAdvisor has tripped on its own stock price and has gone from just below 20 down to just below 10 before coming back a little bit. So it's trading above $10 a share. And for whatever reason you might be looking at it, if you believe it's bearish, shorting this stock is it just doesn't make sense. It's already $10. How much lower can it go? You know, you've got potentially it could go to zero. I don't think it's going to get there. anytime soon, but I do think it could drift down. But what if something happens and it gaps the stock price up? Because I believe the volatility on this stock is to the upside, even though the pattern is down. So to me, the best way to take advantage of this is not shorting the stock. It's looking at options. And the first thing I can do is look at a put option. So I've got put options on here out to May 15th. So again, buying a put means that I'm looking at the right to sell. Here's the $10 put, 75 by $1. Okay, so you might think, wow, that's cheap. But I mean, $1 represents 10%, roughly 10% of the price of the stock. So it would need to move at least 10% for you to break even, right? So this is the first thing I'm looking at. So to buy that put, I'm simply going to move my mouse over to the ask portion. I'm going to click on that, and it's going to put in the difference between the bid and the ask. So it's actually putting it mid price at $88. All right, $88 max risk and $911 max profit. In order to get that, it's got to go to zero. Let's bring up the risk curve. The risk curve is going to look like this, which shows me if the stock goes lower, the put gets more valuable. You can see that going on right here on the risk graph itself. So that is how to construct a put using Hub's database and using the Hub option platform. Now it's going to look like this. And what it really tells me is that, what does your system tell you if you want to buy puts? And does your put price allow for profits if you hit your target? So the break even on the TRIP case study is $9. If you pay $1 for that put, the double is going to be $8. The stock's got to get to $8 because then the put will be worth $2 in value. So the next thing I want to do is compare that. I already know I like it better to short stock, but do I like it better than maybe a put spread? I want you to kind of keep some things in mind. You're talking about, 90 cents to $1 to buy the put. But what if we could buy a put spread that was very close as well? Well, the Q numbers for 2026 are in. Dow's down 6%, S&P down 7%, NASDAQ down 8%, stocks like Google and Amazon down 12%, Tesla down 20%, and Microsoft down 24%, all for Q1. Q1's been a bloodbath for day traders, meme traders, and those who thought their favorite stock was going to go up. Well, I'm here to tell you it doesn't have to be that way, folks. So join me on Tuesday, April 7th at 4 p.m., just after the market closes, as I go through my spring cleaning workshop with seasonality. In just 1 hour, you're going to learn how to remove those dead weight trades that are keeping you down, how to clean up your watch list and sweep away the old stuff for some new things and identify unengaged capital. That means we're going to relocate our buying power with new opportunities in Q2 and much, much more. Just click the link on the QR code there on the screen, or you can check the links below for more information. I'll see you there. What does a put spread do? It gives me the right to sell, and I'm obligated to buy. So what we're doing is we're buying the higher strike put, selling lower strike put, and we're doing that for a lower risk, a lower cost, lower risk, and a better break even. So I want to construct a put spread using TripAdvisor. And now to do that, I can pop right over and utilize what I've got right now. So let me bring this up so everybody can see it. When going to the Hub option platform, if I want to construct a put spread, I could start with the put option I already have in so that I can compare it. And looking at TripAdvisor, if I were buying the May 15th, right, that May 15th $10 put, I'm going to blow this up so everybody can see it. I'm looking at that bid and offered at 75 cents to $1. Okay, this is a 46-day option. But if I want to see if I can make it lower cost, lower risk, better break even, why not look at potentially selling the $9 put? So the $9 put right now is trading 40 cents by 60 cents. I want to click on the bid. And when I click on the bid, that changes everything, right? Let's talk about what it changes here. First of all, it's going to change the look of the risk graph. Now the risk graph has limited risk upside risk and it has limited downside reward. Well, what actually happened here? What happened was I took my buy to open 10 put that was mid-priced at 88 cents. You could sell to open the $9 put, same expiration, different strike, lower strike, same expiration, same number of strikes, long one, short one, but this one's mid-priced at 50 cents. So together, this takes an 88-cent trade, brings it down to 38 cents. Now what I've done is I now have a $38 risk and I have a $62 maximum profit potential and a maximum profit potential that might be quite good. Think about this. If I bought just the $10 put, if we get to 9, I'm just above break even, where all of a sudden the put spread trader has maximized their profit potential. As you can see right here, your maximum profit potential is more than double what you've risked on this particular trade. And I can see all of that right here. I've got the chart in front of me. I've got the option strategy right here in front of me. I've got the details of that strategy down here in the lower right-hand corner, and in the upper right-hand corner, I've got my risk graph, which shows me exactly where that option is theoretically the profit and loss are going to be relative to the price of the stock.